What's up, team? Anybody out there? Joanna's here. Billy D's here. Dramatic slowdown. I can be on board with that. Bill K. What's up, Richard? NB. Rock's waiting on AVGO. Sup, Dennis. Sup. Good afternoon, Michael. Cool. I'm glad 6 of you are joining me for the afternoon meeting. I'm an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRECIPIC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure: I'm out of Palantir short. I'm out of T-Triple-Q short. I'm out of my UVIXI calls that were March 21, 22s, I think. I just took them here. It's a really good move. With the VIX divergence that Pat was pointing out in the close, I just decided to take it off. UVIXI decays like pretty badly, and we're pretty extended down at this point, so I just took it off. All right, we are waiting on AVGO. Are we up $2 from the close? Dude, this market is so insane. I don't want us to be at $2 from the close, just so that I can actually see what percentage we're down. Oh, there we go, AVGO out. Initially trading up. Semiconductor Solutions revenue beats. Broadcom first quarter adjusted net revenue beats. Broadcom sees second quarter revenue ahead of expectations. We're looking good. Broadcom to the rescue? Is Broadcom here to save the market? Implied move is up to 195.85. Thank you, Bill. Coming off highs there a little bit on that AVGO, but looking good. We got Costco out. Costco. Jeez, this stock's over $1,000. This thing's untradeable. $14 spread after hours. Costco second quarter revs a miss. Initially looks like it's trading down a little bit, but it's hard to tell when the spread's that wide. All right, anyway, what I was saying was the SPYs are up $2 after hours, and it's annoying because it makes it tricky for me to try to figure out how much we actually closed down. So including the bounce, we're down 1.4%. If anybody's able to give me a close, because I don't feel like attempting to do the math in my head, if anybody is able to give me what percentage we closed down on a closing basis for these indexes, I would actually appreciate it. I just want to know. The Qs here, with a couple over $2 after hours bounce, are down 2.3%. I got Dennis telling me that the Qs were actually down 2.75%. Dennis, let me know if you have an S&P number also. Yeah, so Qs look like they closed down 2.75%. SPYs also got smoked, and the IWM here is up 50 cents after hours, and even with that, it's off 1.25%. SPY was down 1.8%. So SPY down 1.8%, QQQ down 2.75%, and IWM probably down like, I don't know, 1.4% or something, 1.5% maybe. So bottom line is the market got smoked. TLT down again, but was off of lows, down 0.3%. Thank you, Dennis. And the dollar rested a little bit today, off lows. The dollar's been getting absolutely smoked. Dollar's been getting smoked. Yeah, everything's been getting smoked. The market's been getting smoked. Today was another wild day. It really was. Today was like 2:45 about Trump canceling tariffs on Mexico and Canada again. I really thought we would have gotten more upside follow through on that, but we did not, which is kind of interesting. Broadcom seems like it's helping the market more than canceling tariffs at this point. I'm not 100% sure what to attribute that to. Josh might have hit the nail on the head earlier when he said that, basically said that the market's just getting jaded with this tariffs are on, tariffs are off, tariffs are on, tariffs are off. Because the bottom line is, so, generally speaking, we know that tariffs are bad economically. And if you don't know that, just look at the market's reaction. Every time tariffs get announced, it goes down. And every time tariffs get taken off, the market shoots up. So tariffs are bad from an economic perspective, but markets also hate uncertainty. So at a certain point here, this tariffs on, off thing that we're doing just starts to build out such a degree of uncertainty that uncertainty leads to risk off price action. And, maybe at a certain point we just start to struggle to bounce better on some of those positive news headlines just because, well, maybe tomorrow he just changes his mind again. Because that's really been exactly what's been going on. So I actually thought we would have bounced back better in the afternoon because of the degree of extension. I was actually already buying and then got hit with that headline in my favor, which was nice for me because I was able to liquidate my TQQQ position that I had bought into this up move. I was able to book some profit in the Meta and Google that I had bought into that up move. And then, interestingly enough, we just came right back down. And I'm not 100% sure what to attribute that to, except for the one thing that I just kind of posited there, which originally I think came from Josh. This market is pretty crazy. So we technically got a reset again yesterday. So that makes today again a day one. And that's how markets work. Markets work in periods of expansion and consolidation over time. We've seen that in this down move, and we've been able to do a great job taking advantage of it. Initially short, flipping long here on February 25th for primarily like a big day trade. It paid. We had a rest day that reset the count. Then we had a day one to the downside again on the 27th off the equilibrium zone. Really just after a day one, we got like a little bounce back trade on that next day. Which we also ended up buying, but I think very patiently because we waited for that heavy extension to be able to come in. Bounced us right back into the equilibrium zone where we felt again. 2-day down move off of that. Yesterday we had a reset day, an inside day, let these moving averages catch up a little bit. And then today, this morning, was kind of tricky, I thought, for the second open in a row because we had a really big gap down. SPYs were gapping down about 1.25% as we were opening and as we were doing the morning meeting. So it takes a lot of time to satisfy short-term extension in that situation. So basically, we actually satisfied that for a while through time, and then we caught this big bid up. And that was on headlines too, and I think that was positive tariff headlines also. Like that's when we first were seeing that Trump was probably going to get rid of the tariffs. So we had a huge bump higher on that. We actually even retested 580, which was a great call out from Tate in the VTF on that 580 retest because it's been a really important previous support zone, which, wow, look how well that held as resistance today. And then they started to fade that news here in the afternoon, and we rolled down really hard. So, for me, my approach on this market, as I was kind of saying in the morning meeting, we were like $9.50 extended in the SPYs and about the same in the Qs, actually. Usually the Qs are more. Both the SPYs and the Qs were just under $10 worth of extension. And it's a tricky spot to do anything. I'm more aggressive right now in this market environment with the market dynamic data that we've looked at to short, and I am more patient to buy. In a lot of ways, this is a repeat of yesterday, but for me, more actionable. So at $9, $10 of extension, normally that's where I want to buy, but instead here I'm actually not doing anything. And then if we can get to less than $5 of extension, I'm beginning to short when normally I would wait for the ADMA. And that enabled me to actually short the Qs yesterday afternoon, and that really benefited me, obviously, when we got the big gap down this morning that I had, an okay sized position in both the Qs and Palantir short for today's gap down. I covered that position though, basically pre-market, because we were back to $10 extension. So $10 extension right now, I'm not willing to buy, but I'm willing to cover the short. And so that's kind of was the initial trade. I was like, all right, I'm covering the short. We're $10 extended. I want more than that. I want 14 or 14 plus extended. And especially because today would only be a day one to the downside, I want to be especially patient. So instead, we got this bounce back, and then into this bounce back, I mean, SPY high of 580 today. At highs, this tail is fake, by the way, which is annoying on this candle. But SPY 580 got us again to about $5 extension away from the ADMA. So I was rebuilding into my Palantir and my TQQQ short into that up move, just to then get paid and to fully liquidate it when we became $10 extended again. To then eventually, and I was really, really trying to be patient on this, flip to the long side for the, for some of those like more aggressive day trades off of extreme extension on the daily chart that we've been successful with on 4 different occasions now. This was occasion number 5. So, and actually, the longs today, of the 5 different days that I've gone long off of like real extreme downside extension at the index, I made the least amount of money in them today. Still made money in all 3 of them. I made the most in the Qs, an okay amount in Google, and Meta. I just started too early, and then it was weak, and I just ended up making a real small amount on it. But 5 for 5 on just being patient and waiting for that extreme extension, with today being the least profitable of them, and that's with being helped by headlines actually moving the market a bit in my favor. So not quite as good, but it still worked. I actually started buying around here at around 140 off of this candle. We had like a little bit of a push through failure to new lows off the 1245 low that tailed right back up. So I started by buying some Qs, and at that point also, we're trading at 571 with the ADMA on the daily at 585 and change. So we've got $14 plus of extension on the daily chart here, and then you get this little signal on like the push through failure of new lows that tails right back up. So I started buying initially Qs, and then I bought Google, and then I bought Meta. Meaning to have these once again be very similar day trades to the other 4 times that I've bought when we've become $14 to $19 extended to the downside in this market. Q's paid me best. I fully liquidated the QQQ position into this up move here when that news actually hit. Google and Meta, I probably should have, but did not. No should-haves in trading. But I really thought that actually when that headline came out, when you consider that headline with the amount of downside extension that we had, that we would have rolled up better than we did. And we just stayed heavy and stayed weak. And like I was saying before, I'm not 100% sure what to attribute that to. But at that point, I was all out of the Q long. I did not get back into it. I did continue to manage Meta and Google and kind of liquidated them into the close to put a few bucks in my pocket. But the game plan in this environment has just been the same for me. The game plan in this environment has basically just been the same for me. It's been recognizing where the market dynamics are first and foremost. It's not. There's a lot of things that maybe you could get your conviction from right now to be short selling this market. For me, it's not. I don't know. I guess to some degree it's a little bit of everything. It's me thinking that tariffs are just really bad for the economy. It's me seeing the market become concerned about a growth slowdown. But the thing that really gives me the conviction to be more aggressive on those shorts right now and more patient on the longs is the market dynamic data that we saw from CTAs, who we know could potentially have been $10 billion worth of sellers today, combined with vol control, which we know become sellers. You can scroll up in the VTF and find the chart that got posted this morning to see what the numbers are. But we know that vol control sells at a percentage down. They sell even more at 2% points down. So you got force selling from CTA still in a big number. You got then force selling that comes in from vol control, and that's heightened by, per Goldman's note from last night, a environment of $1 billion of negative gamma. So we push down a percentage point. We are selling an additional $1 billion there. That's what's given me the conviction more than anything else to want to really push the shorts in a shallow way and be really patient on the longs. That's going to change at some point. And we need to continue to monitor that data for when it changes, because when that data changes, for me, is when the game plan is going to begin to change. Because if you circle back to Pat's note, I actually thought that there was one particularly interesting thing in Pat's note today that came from Evercore, which was a bull thesis and a bull note. And there's nothing in here that isn't untrue, that can set us up for a big bounce. And if anyone traded 2022, which was a bear market, and right now we're not in a bear market, but the price action certainly feels more similar to bear market price action than bull market price action. That's for sure. But if anyone traded 2022, you remember there were face-ripping rallies over the course of that bear market, and that will come in. We will get a face-ripping rally that'll overshoot what people think the market can do on the upside. But I really think that the key to that will be recognizing that the CTAs have sold so much stock that they are no longer having the capacity to sell $40 billion of SPX in 4 days. So that's something that we really need to pay attention to, because at some point these market dynamics are going to change. There's a potential of that beginning to happen on March 14th. That's when traditional inflows begin to come back in. I do want to see the other data as we get a little bit closer to that date, and I do want to see whether or not we have a government shutdown, because that will obviously impact things. Then we got OPEX on March 21st, and then another sell thesis that I've really been leaning on in my own head, though, is as we approach tax day, that's going to force even more selling. And I'll tell you what, it's going to force tax selling from people who made a lot of money last year who are now losing money this year, but they're still going to have to sell stock in order to be able to pay taxes, which is going to be interesting. Unless, of course, they've been following our team and they've been short from highs, in which case they can pay their taxes from profits. Yeah, that's just kind of my big picture thought process with the market and the game plan. Closing above the 200 day is interesting. I wanted to highlight, and I wanted to try to find it first on my own, but I wanted to highlight a couple interesting periods of time in my career where the market traded below the 200 day. This 200 day is so widely spoken about, and I don't watch CNBC on TV unless Josh Leffler forces me to when I'm in New York and we're both in an office together. But I can only imagine that, everywhere in the financial universe, from CNBC through financial Twitter, is all talking about the 200 day now. And, I say it all the time, moving averages are not support and resistance, they're squiggly lines. But the 200 day in some ways is a little bit different, because it's so widely looked at that to some degree it acts as a self-fulfilling prophecy, where you do get some buying that comes in on that first test of that 200 day, and you will also get liquidations that occur on a close below that 200 day. I've just seen it happen enough times. But, what I always say with moving averages is it's the slope of the moving average that's important. The slope of this 200 day is still pointing higher. The essence of trend on a very large time frame is higher. Can that reverse? Absolutely it can reverse. It would require us to get below the 200 day and hold below the 200 day for a significant enough period of time that this thing can first flatten out and then eventually roll over. And if you look at 2022, that did happen, right? Look at, let's zoom in here. Look at how much time it took to get the 200 day to actually roll over to a declining slope. We broke the 200-day really for the first time in January 2022, January 21st, 2022, and the 200-day didn't really begin to decline, I would say, until May. So you basically had to spend. I know that there was a couple quick pops back above the 200-day over the course of that period of time, but you basically had to spend like 3 months below the 200-day, and at a certain point get the market to be significantly beneath it in order to just begin to see the 200-day slope actually be able to roll over. That's one thing, and then the other one I wanted to point out was, man, when was that? I've been trading for too long. I know it was early on in my career. Let's take a look at this one right here. There's actually a couple examples of it. How do I zoom again? I think it was this one right here. Yeah, this one I remember very, very well. This is the one I'm talking about. 2012. I'm a couple years into my career with T3 at this point. And I remember everyone was talking about the 200-day. And we got down to the 200-day. It was a big boost to the start of that year in 2012. I keep saying 2022. In 2012, really strong multi-month up move. You almost have like a little bit of like a head and shoulders top that kind of came in here. We broke the neckline of that at 136. We fulfilled that pattern to the downside. We got to the 200-day. Everybody started freaking out about the 200-day. We closed below the 200-day. I remember like back then actually literally watching the tape, and I did not watch the tape today when we broke the 200-day, but it seemed like the second we broke through the 200-day to the penny, it seemed like a wave of sell stops go off. Then we spent another day and a half underneath it, then we were back above, and then that was the bottom. I mean, that's the bottom till today. I think. I don't think that this bottom, even during COVID, ever got broke again. So imagine being the person who, was like, oh my God, the 200-day is breaking, and they sold at $128 on the SPY, and then the market after a day and a half never ever ever looked back again. But look, the 200-day slope was pointing up. So what matters more is the slope of the moving average, not whether or not the market is trading above or below it. Now, I'm not using that as an example to try to say or predict that that's what's going to happen here, that we're going to spend a day and a half below the 200-day and it's going to be the absolute bottom for the next 13 or 14 years. I'm definitely not saying that. But I'm just saying as like a case study, and there's several other examples over the course of my career where we spent a little bit of time beneath the 200-day and it becomes a major, major market bottom. And if you sold because you were freaking out about the market being beneath the 200-day that was rising, you ended up like selling the low for whatever year that is. So, I don't freak out about the market breaking beneath the 200-day. I freak out more when I see CTAs are selling $10 billion of SPX a day than I do because we're trading above or below a silly moving average, a silly line. So we'll see what happens this time around. I do expect at some point we are going to get a face ripping rally to the upside, whether that happens off the 200-day or that happens off 560 or that happens off 540. I have no idea. Let's just take it one day at a time as we kind of get our updates from the market dynamics, and we can look at them in conjunction with the market technicals, which has been a great approach and a great combination for predicting bigger picture movements in this market. So that pretty much, I think, covers everything that I've got on my end for today. I am happy to answer any questions that anybody may have. Sorry to the YouTube people. I just opened it up. So good afternoon to the people on the YouTube that said good afternoon. All right, so starting in the VTF, for the moment, I'm not seeing anything. Palantir down over 10% today. Sick. Yeah, we have non-farm payrolls tomorrow, right? So that will certainly be market moving. It's going to be interesting to see into this extension what that market looks like. If we were to somehow, which probably isn't happening now that AVGO is trading up, but if we were to somehow gap below today's low tomorrow, I would love that as a short-term buy setup. But again, with AVGO gapping up, trading up on earnings, there's a good chance I think that it'll hold the market in at a minimum, if not bounces up a little bit further. But not seeing any questions in the VTF for now, so feel free to post them. I'll go over to the YouTube. What's up, Steven? What's up, Kevin? From Scott. Hey, Derrick, what did you day trade today? Would you share executions and thought process? So you kind of did already. I can do a second quick review of it. So TQQQ, I was short overnight, got out of my short overnight, re-shorted into the up move, got out of it into the roll back down, kind of everything that I described. It's all based on the big picture though. Like you gotta remember, like you want to see what I day traded. I always start with the big picture, even if I'm just day trading. Like every one of these now 5 days that I've mentioned in this down cycle that we're in, that I've started to buy stock off of that extreme extension, it's been meant for day trades. And I've primarily gone back to the same names: TQQQ, Google, Meta. One day I was shorting Uvixi also, but I've primarily gone back to the same names on those longs. But they were meant to be day trades, but I'm taking them based off of the daily chart. So then this is the long that I described earlier. I was just looking at the SPYs, but the market gave a push through to lows, gave a little bit of a hammer, and then again, daily chart. Where are we on the daily chart? We're $14 extended from the SPYs. I'm not taking this buy if we're not $14 extended on the daily chart. That's what I care about. And then, whatever, we get a market balance, I sell some, I reload some, and then we get the news move and I liquidate the position in it. And I'm basically trading Meta and Google at the same time. Meta I didn't do as well in because it just started a little bit too early and didn't get a big enough of a move, and the stock was a little bit weaker. But I'm trading it pretty much off the same exact concept. I'm almost trading these as proxies to the market. And Google I went after because it was relatively strong, which paid me really well the other day when I went after Google when it was trading with relative strength as well. So it's almost like I'm trading these as a proxy to the market when we hit that extreme extension. I think I'm getting a signal on the small time frame to be able to execute, but I'm doing it in several stocks at once, and I'm trying to look at, I'm looking at the index, but I'm also looking at relative strength. So it's always big picture down to small picture for me. So yeah, I mean that's and I forgot I traded this TNA today. This was also meant to be a pure day trade. The IWM, same chart here, huge gap down, continuation for the first 3 bars, extension on the 5-minute now at 9:45 is getting a little bit silly. You begin to get the bounce back. I'm buying on the way up in that bounce back. Wasn't not an aggressive game plan at all. I wasn't even looking for a full move to the ADMA on the 5-minute, which is what I typically do with a normal game plan. I was being significantly less aggressive. So just bought it, and then I was all out here by started buying at whatever 32.16. I was all out by 32.56 for a few quick bucks in my pocket off the extension. I think that basically covers all my pure day trades today. I mean, I re-entered Palantir short a couple different times on the day after getting out of it, but that was more just a continuation of the trade that I was already in more than anything else. From Liam, what a beautiful day. Long up to previous balance range, then short on the way down after investors along in the balance range look to exit at break even or close. Yeah, I'm not familiar with that term balance range. I've never really heard that one before, but maybe I could learn something new. It sounds like, and I love this, by the way, I love when the people on my team can do this for me. I love when I look at the market one way, and let's say Pat looks at the market in a different way, and then even though we look at the market, we're looking at the market in two different ways. Our thought processes line up. That just gives me extra conviction. That Pat's looking at the market in a different way than I am, but sees the same thing that I do, just means that even more layers of probability are on the side of my trade. So what you're describing, I don't know. I don't know what a balance range is, but it sounds like as you're describing your trades, you're basically doing the same thing that I was doing, long off the opening downside extension on the small time frame, short as we were bouncing back up, and then longing again into the close. I'm looking at it a completely different way than you, and we're doing the same thing. So I think that's pretty cool. It comes from Matt at the Trade Brigade. I'd never heard of him before, but maybe I'll check it out because I'm always open to learning. From Scott, would you explain positive and negative gamma? Sure. I did it in an afternoon meeting relatively recently. Maybe you missed it, but I can do it again. I'll just give you kind of the quick summary. So, so gamma is one of the options Greeks, right? It's basically like the rate of change of the delta. So it's like the rate of change of the rate of change, basically. And why does that matter to us, and how does it impact the market? The first thing you need to understand is in the options world, the people who are on the opposite side of most large customer orders are market makers. So if you're a hedge fund and you decide that you want to buy a whole bunch of calls, let's just say for the SPY, you're taking a long bet, and the person that's on the other side of that is selling you those calls is probably a market maker. A market maker doesn't want to be short calls. Market makers are not in the business of taking directional risk on the market. They're just trying to make spreads. So what that market maker is going to do is he's going to look to immediately hedge himself. The way that you would hedge yourself if you just sold calls is by buying stock in the underlying. That buying of stock in the underlying, that's like kind of what creates these gamma squeezes that everyone was talking about a couple years ago when Tesla was running. It's just like, oh my God, people are buying more and more call options, which just means that the market makers have to buy more and more stock, and it just keeps forcing some of these names. I mean, kind of just saw a little bit in Palantir recently. Just keeps forcing them higher and forcing them higher and forcing them higher. So, basically, positive and negative gamma are measures of what the market makers need to do in order to stay hedged. Because what you got to remember is, sure, if you're the market maker and you just sold calls to the customer, your short calls, you're immediately buying the underlying, but then you have to continue to manage that position over the lifetime of the position. And that's going to mean potentially buying or selling more stock as the options trade moves on, because you're getting, the other Greeks that are moving the price of the contract, and in order to stay hedged, in order to maintain that position, they have to do additional buying and selling. And that's where, we spend a lot of time talking about gamma, but more recently, we've been talking a little bit about like Vega. Like I remember the post-Trump the post-Trump election win, that huge move higher here for several days. That was like a Vega squeeze, Vega volatility. That's what that means. So volatility had been elevated into it because people were buying hedges, and then that had to quickly be unwound, and that actually created a Vega squeeze to the upside as the VIX very quickly crashed back down from very elevated prices that it was actually trading at, given that the market was moving sideways. And anyway, I'm giving you a long-winded answer, and I actually meant to keep it short. But so now, basically, when we're looking at what the gamma environment is for the SPX, it just is basically a matter of what are the market makers having to do in order to stay hedged, based on what the S&P does. So most of the time, we are in a positive gamma environment to some degree or another. We were just in a positive gamma environment prior to OPEX. That was like an $11 billion number. So positive gamma is insulating. When the market moves up by 1%, the market makers have to sell $11 billion of stock in a positive gamma environment. When the market moves down 1%, the market makers need to buy $11 billion worth of stock in order to stay hedged. So positive gamma is insulating. It leads to selling on the way up and buying on the way down. Negative gamma, which we see happen less often, is the opposite. It feeds into itself. When you're in a negative gamma environment, in order for those market makers to stay hedged, if the market moves up, they have to buy more. So right now we're in an environment of $1 billion of negative gamma per the note that came out from Goldman last night. So that means that if the market moves up, a whole extra $1 billion of buying comes in that forces the market to move up even more. If the market moves down, a whole extra $1 billion of selling has to come in. That market moves the market down even further. So when you're in a negative gamma environment, it's the opposite of insulating. It leads to wider ranges and bigger movements. So that's the shorter answer. It definitely gets more nuanced than that when you can start to look at like gamma around different strike prices and things like that, which at this point I'm still in the learning process of and is slightly outside of my pay grade. But for me, just knowing what type of environment we're in. Are we in a positive environment? And if so, how big? Are we in a negative environment? If so, how big? Just knowing what type of environment we're in is hugely important to me because I base a lot of my game plans around that. Knowing that this market can overshoot or undershoot where it would otherwise is really powerful information. When we're in an $11 billion gamma environment, if you're looking for trend continuation, forget about it. You don't want to be having greedy game plans looking for trend continuation when that's what the environment is. You want to be booking profit quickly and potentially, be quick to flip to the other side for the inevitable snapback when you run into selling into an up move. And then when you're in a negative gamma environment, so positive gamma environments have a higher probability of range. Negative gamma environments have a higher probability of trend. So when I'm in a negative gamma environment like we are now, and I have a position on, I want to be more greedy with that game plan. I want to look for trend. I want to look for follow through. If I'm considering going counter trend, I got to remember that these moves can go for much bigger than I would expect that they would because into a down move, it's met by more forced selling. So the only time you can really start to consider going the opposite way is when we like really, really, really extend past where you would normally otherwise expect. So hope that helps, Scott. From Steven, where do you get your data is basically the question. Primarily through the virtual trading floor, primarily through Pat's morning note that he posts every day into our virtual trading floor is a wonderful aggregator of information from a lot of the best, I think, sell-side data that's out there right now. So that is my preferred read. I get it from a couple of places, but that is my preferred place to go. From Liam, can you give some reference to why you use the EMA instead of the SMA? Sure. So good question. This happens to be another question that I answered, a very similar question actually in a somewhat relatively recent afternoon meeting, but I'm happy to do it again. So when it comes to trading, as a general rule, I think that literally everything that you do should have logic behind it, and that there should be a reason behind it. And I do not like the idea of think about technical analysis, memorizing chart patterns for chart pattern's sake. If trading was as easy as memorizing what a bull flag and a bear flag and a wedge looked like, then I could take a bunch of 5-year-olds and make them into billionaire traders because by the time you're 5, you have pattern recognition skills. It is not that easy. So I think that if you're learning what a bull flag is, in order to really be able to learn that, and it, make no mistake, it is a powerful pattern, but memorizing it is not enough. I don't remember what the numbers were, but I read some statistics about, like, I think it was bull flags in particular, about how often bull flags fail. And I don't remember what the percentage was, but it's like a very high percentage. Like bull flags fail. I'm making this number up, like 45% of the time, or 40% of the time, or something like that. That's a very high percentage if you're just trying to memorize what patterns look like. So memorizing what something looks like is not enough. You need to understand the logic behind it. You need to understand what a bull flag actually is. A bull flag is a trend continuation pattern. So that's one, going back to what Billy D and I were talking about with semantics earlier. A lot of times people call bull flags that are not actually bull flags. They're bullish consolidations. They're not bull flags because if there's not an uptrend into the bull flag, it's not a bull flag. If the market was moving sideways, then there's a consolidation in the upper end of that sideways market. That's not a bull flag. That's a bullish consolidation. A lot of people call it a bull flag. It's not. It's different. So a bull flag, you have a uptrend, and then the buyers that were driving the market higher run into an area of overhead supply, and then they slowly eat away at that overhead supply as the ADMA typically catches up to the base of the bull flag, which creates some extra buying power usually just in time for the overhead supply to run out. And then those buyers can push the market through for further continuation of that uptrend, and it's also called like a stair-stepping uptrend. Head and shoulders, Liam, same idea. A head and shoulders is a reversal pattern. If you're not looking at an uptrend into your head and shoulders, it's not a head and shoulders. You have to have an uptrending market and then a head and shoulders and then a break lower. Like what I was just pointing out in 2012, that was the head and shoulders. We had a big uptrend, it created the head and shoulders, it broke the neckline, and then it broke down. If your market's just going sideways and you think that you see like a little peak where we broke through resistance but failed and came back down, that's not a head and shoulders because there was never a trend into it. So, generally speaking, I think that you need to understand the logic behind it. And beyond that, you need to understand what I call layers of probability, right? Risk reward in trading is very simple. It's simple math. Layers of probability, understanding the probability behind any trade is very difficult because probability is super dynamic. There are many, many, many influencing factors on any chart pattern that you might be looking at that will impact whether or not that pattern is actually going to work or not. So you can't just memorize a chart pattern. You have to understand the nuances of the supply and demand dynamics behind it, and then you need to understand all of the other layers of probability that are ongoing. Simple example, you're looking at a bull flag and the market is breaking out and trending higher and moving higher. That bull flag is going to have a higher probability of continuing than if you were looking at a bull flag and the market is failing and moving lower and getting weak, right? That's just an example. So you need to understand all of that. Why am I saying all this? Because the moving averages that I use are like the one thing in my trading that don't really have a tremendous amount of logic behind why I use those specific moving averages. Why do I use an EMA over an SMA? Why do I use a common one that question I get a lot is why do you use the 8 EMA instead of the 9 EMA? A lot of people use a 9 EMA, I think, because like Thinkorswim automatically sets people's charts to show a 9 EMA. I don't have a good reason for it, to be totally honest. My reason, and it's a bad reason, is that when I first started as a new trader with T3 in 2010, and I sat down and turned on my light speed for the first time, and I got another trader's layout, he had an 8 and 21 EMA on it. And I know that they're fib numbers, but I don't care about fib numbers. So some people use them because the 8 and 21 are fib. But I have learned to utilize those moving averages as tools to measure equilibrium. And again, they're not support and resistance, they're squiggly lines, but utilizing them as tools to understand technical equilibrium in the market has been invaluable for my approach overall as a trader. So I've learned to use them. I continue to use them. They work very, very well for me as a concept. Again, you need to understand all the other layers of probability. And moving averages are never a trade. It's not a trade. It could be a target on a trade, but like to me, a moving average crossover is not a trade, or whatever. You need to still find your actual trade setup, and then you're using those moving averages as some sort of layer of probability. So appreciate the question. I hope that helps. Where was I? The next question in here is from Kevin G. Should I be worried if I have the same market view as Jim Cramer? No. You should not be worried if you have the same market view as Jim Cramer. I mean, this is my opinion on it. Jim has turned into a meme where everything he says, the opposite happens. It's completely not fair. This man has a storied career in Wall Street, has been doing this for a very, very, very long time, has had immense amounts of success, and he should be respected. His job, what he does, is very difficult. His main job at this point in time is to be an entertainer. That's his first job. His second job is to give you his opinion on stocks. But his main job is to be an entertainer. And part of him being an entertainer means that he needs to do the impossible, which is always having an opinion on everything, because that's what makes ratings. I love that you guys listen to the afternoon meeting. The people that tune into YouTube and give me like the thumbs up and stuff. I do genuinely appreciate it. I'm not doing this for people's entertainment. If I was, I probably would have the video camera on and all that, which I do at the office, and I would have an opinion on everything. I will say all the time I have no opinion on stuff. But, again, Jim's trying to provide entertainment, and he has to have an opinion on everything. And when you have an opinion on everything, you're going to be wrong a lot. And it just is what it is. It doesn't take away from his credibility of having a storied Wall Street career. It doesn't take away from his credibility of being right a lot also, or maybe even more important than being right, providing good information. I haven't watched Jim Cramer's show on CNBC in such a long time. I really don't know. But last I remember, from however many years ago it's been, he used to provide good information. Draw your own conclusions and if it's a buy or sell. But he could tell you what the PE is and everything else. Dr. Strange says he's right less than 40% of the time. But guess what? You could be right less than 40% of the time and be a super successful trader. And Josh saying, so Dennis saying that Cramer's Confessions of a Street Addict is a pretty good book, actually. Most people don't know that side of him. And Josh saying his original book, Josh, is that the same book? Give me the name. His original book is one of the best books for a new trader to read. Thanks, Josh. I haven't read any of Cramer's books. You think so? Cool. So that's my opinion on Cramer. Draw your own conclusions. Make your own decisions on if something's a buy or sell. But you can utilize his information that he provides to help you draw those conclusions, provided that he's providing facts. So that's it. Next here on the YouTube, we got lots of questions today from Scholastic Pie. In your trades, when you trade long or short at regular intervals by adding to and reducing positions, your net P&L would just depend on the interval size and the total position of the trades. Yes. How would you scale up such a strategy, either by increasing the position size or the interval size? Yes. How do you deal with fees and commissions with so many trades? Which eat into P&L. I don't care about commissions. Commissions are a cost of doing business. When I go back at the end of the day, if I saw that I bought 100 shares and made 10 cents on it, my head automatically calculates that I made $8. And that's it. A commission cost is the cost of doing business on a transaction, on a trade that you put on. If a trade is worth taking, it's worth the price of admission. I pay a boatload of money in commissions. I can't tell you how much money I pay because I never look at the number. my net my gross P&L does not matter. I only look at my net P&L, and that's it. And I really never look at the gross number ever. Well, why bother even getting in my head? From Liam, are you permitted to use Thinkorswim with T3, or would you recommend Lightspeed? I'm just very familiar with Thinkorswim. When you are a trader through T3, you have to use one of the platforms that T3 offers. Thinkorswim is proprietary to TD Ameritrade, which is now Schwab, I think. So we have no access to a software that is proprietary to a particular broker. We have access to some great professional softwares. We offer Lightspeed, Storm Trader Pro, Dash Trader, Silex, and by far my least favorite, Tachyon, depending on which company that you join. Generally speaking, probably with the exception of Tachyon, they're all excellent trading softwares that all have their own individual ups and downs. Every software has its own, benefits and downsides and things that you actually have to get used to. So yeah, I mean, I've been using Lightspeed for 15 years. I think it's great. People like Sterling. Some people swear by DAS. But yeah. Scott says Kramer is getting old. Yeah, he probably should consider retiring. Maybe you can slide into CNBC. I would totally go on CNBC if they invited me. I don't know if I got the right connections to get me there, but I think I could do a good job. I probably would try to be a little bit more entertaining and try to have some more opinions. But I think it'd be cool. I'd give it a try. But I wouldn't be willing to live in like what Josh Brown does. I would not be willing to be a regular person who has to live in New York to actually go in there to do it. But I'd go in as a guest. Home Shopping Network. I'm long, baby. Home Shopping Network's been making numerous requests for me. I'll go on, Josh. Tell him yes. I'm long the stock. I'm literally long the stock, Josh. Yeah, and you could still have a Thinkorswim on the side on your own if there's any baskets or anything on that you want. Are you still long AMD, and if so, why? Yeah, I'm still long AMD. My position on this has been pretty small, and I've been able to work it back and forth in a way that I've been fairly happy with. Originally, I was planning on getting out at $100 if it got down there. It got down there. I have not. You could argue that I'm violating my game plan, and you wouldn't be wrong. I am. But I've done well with it enough on the way down that the amount of P&L when I was originally calculating my maximum loss on this trade, the amount that I would have been down at $100, I'm down way less than that. I am pretty sure, I haven't looked recently, but I'm pretty sure that I'm down overall in my AMD swing trade. But again, I'm down much less than I should have been at $100. So I'm like, you know what? There's an amount of money that I was originally willing to risk in this trade, even though it's down to the spot where I said I was going to get out. My P&L is not at that amount, so I'm willing to kind of stick with it a little bit further and kind of continue to work the position a little bit. And I don't think it's a bad company. It's down from 228, 230 down to 99 now. It's fully round tripped back to where it was in 2023. That does not mean it needs to go up, but I'm going to continue to stick with it for the time being. And my position on it has now actually gotten a little bit bigger, but it's really really fairly moderate. I mean, try to figure it one. Yeah, I don't know. I'm not going to try to figure it out, but it's a pretty moderate position. From Vikas, is there a specific basket of stocks you think is worth following in the downtrend? It keeps changing. I know with the macro changes. I was just thinking if we watched all the momentum names since December, we could see the market starting to break down before last Feb. Yeah, sure. I mean, I would give Tate a shout out on that. Tate was calling out that the IWM is a leader and that this IWM failure back here in December was really the first signal for this down move that we that we had. So, there's one thing to that. I don't have a specific basket of stocks. I look at like a lot of different groupings of stocks. I'm always looking at Mag 7. I'm always looking at a lot of these different growth names. And I mean, we were saying even when the market was at the top that the breadth profile of the market was in such a way where at this top Mag 7 looked terrible, but they were just ripping up Hims and Palantir and these like stocks that are trading at absurd multiples and didn't actually belong at those prices. So for me, that was actually an additional signal at the top. That was one of the things one of several things that I was looking at that was making me bearish as the market was breaking to all-time highs. Was what we were seeing underneath the surface just didn't look healthy. But I don't have a particular particular basket for you. It's just looking at all this stuff together. Sorry, Richard. I think I missed a question from you earlier as well that I just missed. Are we in danger of seeing tomorrow's NFP dragging down today's after-hours rally led by AVGO? When you're going into a economic event, you are in danger of everything happening. We're in danger of the non-farm payrolls number boosting the market to further boost what's already happening from AVGO. We are also in danger of non-farm payrolls number coming out that the market doesn't like, that then causes the AVGO-led rally here after hours to fail. It's on both sides. There's not really too much extra we can be doing from a positioning perspective until we actually see the numbers hit tomorrow. Tate saying you know it's the end when they start running the garbage, or at least near the end. Yeah, I mean it's been that way for a while. The only thing when they start running the garbage, you know that you're getting closer to the end, but you don't know how long that can last. It could last a couple days, a couple weeks, or like it did at the end of 2020, early 2021, it could last for months and go so much further than you ever think it would. And I would argue that this time around a lot of stuff went a lot further than I thought it would. Palantir 126? Are you kidding me? What was the forward PE at that number? It was insane. It would take like 25 years, 230 forward PE multiple. Yeah, it'd take 25 years to grow into that price. It's crazy. I don't think we can touch 6350 SPX this year. That'd be new all-time highs. So going big this year on your positions or using heavy leverage is more risky until then, because it can fall even further. It's like 2022 or more rocky because of interest rate drops, and 3-month might continue to go down. Yeah, I mean, I agree with you on the 6350. That'd be a big call if we were able to get up there. But I don't fully agree with you on not using leverage. I just think that you need to know your time frame. This is an environment for a lot of trades right now for quick hits, like recognizing some of the stuff I was talking about earlier. And you can capture huge moves on short periods of time if you can time them properly and execute them properly. So there's a lot of opportunity, but that opportunity is actually on a little bit of a smaller time frame right now, and that's obviously just fine. Oh man. All right, you guys are starting to wear me out, but I love the question, so I'll just keep going here. Back over to the YouTube. Tesla's entering a major supply zone between 245 and 270. You mean demand zone, I assume, because it's on the downside. Yeah, I would argue it extends down to 240. It's like probably like a big zone that extends down to. I would describe it as like 265 to 240. There's a lot of price congestion in there. I'm just seeing now we fully round tripped the boost that Tesla got from the election. And then what was that headline that Josh posted earlier today about Trump and Musk? That Musk has got to chill out a little bit or something. I got to find that and reread it. It was interesting. From Liam, how do you handle managing your P&L? How do you determine what percent you withdraw to create your salary versus increasing your buying power in the account? How do I manage my P&L? So I look at my P&L, but I I just trade my trades, really. So I really just kind of trade my trades and let the P&L kind of be what it is. I very very quickly actually forget how much money I made or lost unless it's a very significant number that I remember. But there's a good chance that by the time I'm eating dinner today, if you asked me how much money I made today, I won't remember what the number is. I just kind of falls into the line of all the other days of P&L over and over and over and over again that have added up. The headline was Trump puts new limits on Elon Musk per Politico. The source is Politico. So that's how I manage my P&L. I manage my P&L by not managing my P&L. I manage my trades per my game plans. And the second part of your question, how do you determine what percentage you withdraw to create your salary versus increasing your buying power in the account? I'm gonna skip on that question. It's a little bit of a personal question on how I do it personally. I think that the answer to that question is going to be very unique for every individual based on their account size, how long they've been trading, and what their goals are. So I would say though that there should be a plan behind it, and I definitely have a plan, and sometimes I make adjustments to that plan, but I definitely have a plan on just my account management insofar as giving myself paychecks versus letting the account. No apologies at all. All questions are welcome. That's the worst answer that you're ever gonna get from me is the one that I just gave, and all questions are always welcome. But I do definitely have a plan in place for how I do that, and that plan is based on my own unique goals and time in the business and account size that I'm working with. Second part of the question, would your strategy be different from mine being 23 and new to trading? I'm comfortable with making less in the beginning stages of my career. Yeah, probably. Almost definitely. Different account size than mine, different stage of your life, for sure. So it should be. When I was dealing with a much smaller account, I was much younger. I was very focused on building the account up to try to get to certain sizes to be able to add scale to my trading to size up. And I lived, I some people might argue in some ways I still do, but especially back in those days, my goal was to build the account up. So I tried to only ever take money out that I needed to live. And I chose for a long time to live like a relatively humble kind of lifestyle and not spend much money because I had goals, and those goals required me to reinvest my money in my business. So, I definitely was frugal, and Josh probably would argue that I still am frugal, but it's just kind of my personality. I don't care about stuff. I don't really care about stuff too much. So I could care less about buying clothes and stuff like that. It's just not my jam. I spend a lot of money on experiences. That's where I like to spend a lot of money on doing things on. I spend a lot of money on the vacations that I go on. Like that's kind of how my life has evolved. But the reason why I'm even saying any of this is to circle back to your question. When I was a young trader and I did not have a lot of money, I started with T3 with $5,000 in my account and 6 months worth of life expenses saved up. I did everything I could to build that account up and build that account up and build that account up. And now, there's not a day that goes by that I don't swing my starting $5,000 account multiple times over. And as a result, I also, have different goals for what I want to do with my account and the money that I make in it at this point. So I hope that helps a little bit. Definitely a big advocate of people that have smaller accounts of doing what they can to build it up in order to be able to add scale onto their trading. I appreciate the questions. From Joel, I got in here late. I'm sure you've already spoken on this, but what are your thoughts on selling off whenever Mexico tariffs got eased? Yeah. So I think what you're talking about is this move in here, and really kind of this move in here. Today was an interesting day, and I did talk about it. We did see boosts initially whenever we saw any language come out about the tariffs getting eased. That's what caused this initial bump here at 10 a.m. That's what caused this bump here at 2:45. But they were relatively short-lived. We came back down, and I don't have a good answer for that. I really don't. Not at this point. What we have seen consistently is that tariffs eased, market up, tariffs on, market down. And that makes a lot of logical sense to me. So any tariff easing where the market doesn't go up doesn't make as much logical sense to me. The only thing that I kind of posited a little bit, and this actually came from Josh earlier in the day, is we know that markets hate uncertainty. And I think that we're just hitting a point here now where we are going from tariffs on to tariffs off to tariffs on to tariffs off. That's what happened in a very short period of time. It sounds like it's going to continue to happen. It's continuing to be in front of us, where this now is beginning to maybe morph into just an additional layer of uncertainty for the market, and markets don't like uncertainty because every other day he's changing his mind on what he wants to do with tariffs, and that's uncertainty, and uncertainty is bad. So that's all that I've got on that as even the beginnings of a thought process, because otherwise I actually really would have thought that we would have closed better today on the tariff relief headlines that we had, and we didn't. Between the tariff relief headlines and how extended we were to the downside, I thought that we were going to close better today, and we didn't. Still managed to make a little bit of money on those day trade longs in the afternoon, but they could have been better. All right, I'm starting to lose my voice. I really appreciate all the questions. Hope everyone is learning. Hope everyone's improving. Hope everyone's making money. Keep up the good work. I'll see everybody tomorrow. I already turned off the VTF, but another question just came in from Dennis in the YouTube. Anyone at T3 trading pre-market imbalance strategies, or is the strategy dead? I know for sure that people are trading imbalance strategies into the close. I know for sure people are. I don't know about the pre-market ones, but into the close for sure. Have a great night, everybody. See you tomorrow. Give me the thumbs up. Tell your friends. All that good stuff.